Give me your short take on the minutes today.
Sure. We think the Fed has continued to migrate towards a normalization. Obviously, they've put some caveats in terms of data, but we think that they are dead set on, a hike in June, and we think that's a near certainty.
You think they're dead set on a hike in June? Why do you say that?
We do think so. I think they believe that they're so far below the normalization process that they need to move. And while there was some temporal softness in Q1, we think there is certainly, we think an option later in the year to potentially hold back on further cuts.
Right.
But think June is a foregone conclusion.
Okay, I want to bring up, guys. Can we bring up this chart here that Kathleen had used earlier as well to just show our viewers again, Trey? It's just taking a sampling of one piece of or two pieces of economic numbers, which you see here on this chart with the aqua line, that's consumer spending, right? Which just recently has kind of started to tank. Consumer confidence, though, Trey, continues to go up, right? So it's a little bit confusing. This is just one example of confusing economic data that we've gotten. So you look at that and you say that aqua line is just a transitory number then. Is that what you're saying?
Well, I'm saying that there's a lot of other impacts on the consumer right now. I think confidence remains high. I think people remain optimistic from a small business and an employment perspective. But I think that there are other things that are crowding out consumer spending. I think rising healthcare costs and uncertainty from a healthcare plan perspective on a go-forward basis is a big a reservation for a lot of consumers going out and spending incremental dollars.
Trey, it's Yvonne in Hong Kong. We know rising rates are imminent, but I know you've been doing quite a bit of research on when this is really going to start impacting the consumer. And we saw that drop in new home sales, existing home sales last month out in the U.S. Yet we are seeing that mortgage rates have come off the peaks that we saw in March when we saw this surge after the election. So how much higher do rates need to go before we actually start feeling that pinch?
The affordability for housing is still so strong, and the average housing price or the monthly payment for housing is so far below where it's been in its historical trend. We think the housing market can absorb actually a 1% to 2% move in mortgage rates. There may be a temporary blip but from an affordability perspective, we don't think that it has a material negative impact on home volumes, if you will, sales volumes.
Yeah, and of course, we're talking about mortgage rates, but you talk about the 10-year yield. I mean, we've seen that forecast farther and farther away from 3% for 2017. Why do you think that we do see this rapid change of heart? Is it more on disappointment on what the Trump administration is going to be pulling through in terms of their growth agenda, or is it more going to be on the eco data?
I think that there's been already a pullback in the Trump trade, if you will, in terms of people's expectations around tax cuts and deregulation having a big impact on equity markets. I think certainly some increased level of uncertainty around economic data is causing people to, maintain their positioning in the 10-year, from a liquidity perspective and from a risk mitigation perspective.